to the Trust the Plan podcast. I'm Nick.
And I'm Preston.
And Preston, today we're talking about the markets. We had the recent correction. The markets are down like 7% from the all-time high. We reached a point of minus 10% a week or two ago. So we want to talk about what is a correction and what happens next.
Yeah.
So let's look into that crystal ball, huh?
Yeah.
All right, so we have a couple charts that we want to share with you. And let's see if I can do this quickly here without any mistakes. Yes, here we are. So this is a chart showing the S&P 1 year after correction. So what is a correction?
Yeah, correction is at any point when you look at the peak of where the market was to where it is now, if it's down 10%.
Okay. All right, so basically from mid to late February, I think February 19th, through early March, we hit this minus 10% threshold.
Yep.
Okay. And so it was exactly, I believe it was 2 weeks ago from the day of recording. Today's the 27th. Yep. I believe it was 2 weeks ago. It closed in correction territory, meaning the Thursday at 4 p.m., the S&P was down 10%. And NASDAQ had already been down 10% much earlier, as well as small caps. But the S&P is like, the index.
Yeah, that's
right?
what everyone looks to when they're trying to judge how things are going.
Exactly. So it was minus 10%. Well, now it's come up a little bit. It's maybe about minus 7%. Okay.
Yeah.
So we're not in a correction anymore, you could say.
Right.
But we hit a correction 2 weeks ago.
Right.
All right. But it still feels like, we're in correction territory.
Right.
Okay. So I would say we're still experiencing this.
Yeah.
But I often say, if people are looking to invest money because they have extra cash, maybe they had a bonus, or maybe they won the lottery, or maybe they had an inheritance, or maybe, they've just been saving up and they're looking to put the money to work. Oftentimes we'll say to them, well, let's do a dollar cost averaging program where over the next 6 months or 12 months, we can put that money to work each month, right? That way, we're not picking one day to buy in.
Right. Yeah, you never want to throw all the money in on one day because, just going off recent history, what if you threw all of your money in on Jan 1, 2022, where every single day for the entire year the market stepped lower?
Yeah, it didn't bottom until October, so it was like 10 straight months, basically, of declining markets. Yeah. So if you did a 6-month dollar cost average that year, you'd be, it wasn't perfect by any means, but you'd be much more happy. If you did a 12-month, you'd be, feeling even better. Right. And of course, we have 22 in this chart here. So this chart says if you purchased, it's the equivalent of purchasing 2 weeks ago, right? Like we were saying on that day in March, on that Thursday at 4 p.m., you buy.
Right.
Seems reasonable.
That is what we did for our clients who are on a dollar cost average program is. I think it was like that day or maybe the day before we said, let's accelerate a little bit.
Right. So if we say we want 6 months of equal amount of purchases each month on a cadence, we'll also tell our clients, but if there's an opportunity, like to buy the dip when it's down 10%, we'll take an extra shot that month.
Yeah.
So maybe, let's say we purchased on March 1st for that month. Well, maybe we would also purchase on, March 15th. If it went down 10%.
Right.
So we take an extra shot. And so a year later, if you take that extra shot, okay, this is, the historical average. So it goes back to 2008. We have 15 corrections in like 17 years. So it happens, a little less than once a year, okay? But I always tell people, don't be surprised if the market goes down 10% this year. In fact, I was on the TV episode with Steve, like on January 2nd or something, saying, when it goes down 10%, because it probably will, what are you going to do? And the plan should be, if you're opportunistic, to buy like we're showing here. And if you are taking income, to be aware that it's going to happen.
Right, exactly right. And it's so easy to forget in the good years that a correction did happen, right? Like 2023, 2024, the correction happened over the course of like 3 days. It was super quick down, super quick back up.
That was in August.
Yeah, 2024 finished as a great year, but you got to remember the correction did happen.
No one remembers it.
No.
It was like 9.9%, by the way, so it's
right.
it didn't make the chart.
Right.
It was literally down like 9.9, and then by the end of August, it was at a new high.
Yeah.
So, okay, so in 2008, you can see that it was a bad strategy to follow this approach. And in February of 2022, it was also a bad strategy. So 2008, right, speaks for itself. You know, it was just the worst time of my life. I'll put that out there.
Yeah.
We can laugh about it now because we recovered and everyone's in good shape, but it was truly awful. Now, in February of 22, I can remember vividly because I was traveling up in Cairo, Michigan, in the Thumb area, meeting with clients, and the news just came that Russia invaded Ukraine, like overnight, okay? And so it was a bad market. We got a lot of calls at that time. Simultaneously, the Fed was raising rates. The market hates that. So as you mentioned, it went down most of the year of 22. And that's why we can see if we would have purchased in February of 22, when it hit that minus 10% mark, you know, we still had more pain ahead of ourselves. We would have lost money over the next year, minus 7%. But you can see there's also a number here, April of 22. And that what that tells us is that after the February drop, it went back up and then dropped again 10%. It doesn't mean it went down 20% during those 2 months. It means that from the most recent high, it had dropped another 10 because the market goes back and forth.
Right.
And because it wasn't actually bottomed out till October. But if you would have purchased in February and April of 22, you know, you're thinking, gosh, we didn't really do much for me, right? But then in September, it had a 10% drop before it ultimately bottomed in October, and now you're making 15%. And then again, we had a 10% correction in October of 23, and that's when we had this fourth quarter of 23 and all of 24, which was outstanding for your 41% gain. I don't know if you can see that behind Preston's melon there. Okay. But ultimately, we have 15 time frames here where 13 times we would have been rewarded, sometimes a little bit, sometimes handsomely. And then we have 2 times when one time we lost our shirt and one time we were disappointed. But ultimately, the only thing that's in common between 08 and 22, basically it was a recession. I know that in 22, it's not officially labeled as a recession, but the GDP did contract for 2 consecutive quarters. And I studied econ. I'm not an economist, but I studied econ. And that's the definition. That is the textbook definition of a recession. Down 2 quarters in a row. And it was. But for some reason, they didn't, classify it as a recession. And there you have it. So recession in 2008, recession in 22, bad times to buy in because there's still more pain coming. But chances are it's not a recession.
Right, because like you were saying, most years there is a correction. And even in the recession, if we look at a couple other lines on the chart, October 08, November 08, January 09, and then even more recently, I think there was one for 22. Yeah, April of 22. All of those, you're in a recession when you're putting the money to work, which, feels painful at the time, but all of those you were rewarded. It was just, unfortunately, bad timing of that recession.
Okay, now let's talk about, real quickly here before we finish, the University of Michigan sentiment surveys. And it's broken down on this chart, Republicans and Democrats. So I want to highlight a couple things. If we go back to 2017, when Trump was elected, look at what happened with Republicans. The confidence went to the moon, and Democrats went down, okay? And then Democrats stayed level until 2020. When COVID hit, went down. Republicans went down in 2020. Biden's elected. Republicans continue to come down to lower levels than in the COVID lows, okay? COVID low of confidence, Biden level of confidence. Now, Biden's elected, Democrats' confidence goes up, okay? Then in 22, they both come down together with the recession that didn't happen. And then as we come out of the recession, confidence is moving up. And then on the far right, we have Trump's reelection and the red Republican line goes up. Not as much as it did back in the day. Okay, I think that's interesting. But now what is really interesting is that the Democrats' consumer confidence goes to a new low below COVID. And so, look, I know that 22 is painful. Why would Republican consumer confidence be even lower than the depths of COVID? Makes no sense. It's political.
Right.
Okay? It's political. Why would Democrats right now, when things are fine, be lower than the depths of COVID? Because of politics. Period.
Yeah.
We have to separate our political views. We just have to stop doing this, guys. This is crazy.
Yeah, it's been on repeat for the last several elections, and that's why we always talk to our clients who are, at whatever time period they're feeling that very low sentiment. You have to ask yourself, what if I'm wrong?
Yeah, that's right.
What if my feelings about the political party in charge doesn't actually come to fruition as far as impacting the stock market?
I think that's well said. What if I'm wrong? Because, if you would have sold because your person didn't win, you'd be missing out on a lot of gains in the markets over the years.
Yeah.
So I would just encourage you to kind of take politics out of it. So if you'd like to speak with us regarding your portfolio during these correction times, please reach out to us at peakwm.com. You can schedule online. Also, please like the podcast. Please share. Please ring the bell. We appreciate you. Thank you.